to us. And Andrew has held a number of positions before joining the University of Melbourne. He has been at LSE, Oxford University, and as I mentioned before, also JP Morgan for a very short period of time. He has worked on the political economy of international finance and investment, and hopefully will manage to contribute in that area soon. He also has worked on more recently emerging economies and their role in global economic governance. He has worked also on the political consequences of financial crisis and a number of other issues, very interesting, and has written 7 books, I guess, and the latest one has won the 2020 Stein Rocken Prize for Comparative Social Science Research, which is a great acknowledgement of his work. And in the book, there is titled Wealth Effects and a long subtitle. He delves into, with his co-author, Jeff Chivros from LSE, they delve into understanding how the rising wealth of middle class of middle class households and voters has contributed and has transformed the politics of banking crisis. I think this should give a good introduction about Andrew's work, and hopefully what today is going to talk about. Andrew, you have 60 minutes. Andrew prefers to give the talk and then leave the questions after he has given the talk, and he probably will be joined by his co-author. Halfway through the talk, he's gonna mention this briefly in his introduction. And if you have any questions, please raise your hand, and we'll call out your name at the end of Andrew's talk. Andrew, the floor is yours.
Thank you very much, Laura, and thank you to Shani for organizing this. I just wanted to mention my co-author, Young Cho, who's in a hotel room in Shanghai at the moment. Young was one of my very best PhD students at the LSE, and he's had a long career, well, not that long a career because he's very young, but a substantial career in international finance too. So he was the perfect person to help me do this research. So we've been working on that for a few months now. Of course, it's been a little delayed by the COVID crisis and other things. But anyway, we wanted to give you a flavor of what we're doing today. As Laura said, at least myself, speaking for myself, as a political scientist, we have completely different seminar norms to you economists. So I would prefer, if it's okay, to leave Q&A to the end. I'm going to talk for no more than 10 or so minutes, and then I'm going to hand over to Young to take us through some of the results. So I'll just share my screen now. So I hope you can see that. So that's the title, which you've already seen. I just wanted to say a little about why we're looking at peer reviews in particular of international organizations that are undertaking reviews of national financial regulatory implementation and quality. So the basic idea behind this study is to think about the way in which, after the global financial crisis, the G20 collectively promised that they would undertake peer reviews of financial regulation across all G20 countries, and that they would not only undertake these peer reviews, they would also publish them in the interest of transparency and as a kind of commitment to what we generally think of as market-based implementation incentives. These peer reviews undertaken by the Basel Committee for Banking Supervision and the Financial Stability Board added to an existing set of staff reviews by IMF and World Bank staff of financial regulation and financial sector quality. So that's the financial system stability assessments, and those have been undertaken by the IMF and the World Bank collectively since the early 2000s. So the Basel Committee and Financial Stability peer reviews are a new innovation post-GFC that were intended to reflect this general G20 commitment to review implementation and enhance transparency. So both the peer reviews undertaken by the Basel Committee and FSB, as well as the staff reporting and reviews undertaken by the IMF and World Bank, both assume that market pressure can assist in promoting financial regulatory reform, and in particular the implementation of Basel III and related regulatory reforms. So the basic puzzle that's motivating this study is why there are a number of countries, but most specifically two of the most important countries in the world, China and the United States, that had been very reluctant to submit themselves to staff reviews by the IMF and World Bank before the GFC. The United States and China both refused to allow these reviews to be done. And only after the crisis did they accept the general G20 consensus that everyone in the G20 should accept that these reviews should be done, and secondly, that they should be published. So the puzzle arises then as to, why these countries, and indeed not only China and the United States, why are they all collectively agreeing to be reviewed and to have the results of their reviews published, when of course the reviews are potentially embarrassing and problematic. Was there potentially an expectation that peer reviews in particular might be relatively uncritical? Because in a sense, peer reviews are based on reciprocity. And so if a team of reviewers from other G20 countries visits, let's say, Australia, there might be an expectation that as long as these reviewers are not too critical, the Australians in turn, when they go off to do peer reviews in other G20 countries, will not be especially critical either. So the reciprocity nature of peer reviewing may lead to, I think, some concerns about whether they're likely to have a positive bias. It may also be the case that these G20 countries just expected that markets wouldn't react to publication, that basically there'd not be a lot of news content in them, and that market sanctioning would be relatively weak. But in fact, we basically know very little about the extent to which markets react to peer reviewing and to publication. And so that's what really we want to investigate in this project. So we have some theoretical considerations, which is that basically there are some pretty substantial information asymmetries when it comes to understanding the quality of financial sector regulation in any country. So there are insiders that include national regulators as well as large financial firms. And if there are problems in the national jurisdiction, both of these insiders have few incentives actually to reveal regulatory failures to the outside world because of fear of sanction and market reaction. And that means that outsiders are in a relatively poor position often to judge the quality of regulation as opposed to those insiders. So there's a fundamental asymmetry there. And that asymmetry is likely to be greater for relatively low transparency jurisdictions. So if you think of countries like Argentina or Indonesia in the G20, less is known about them. We probably know less about them than, say, the United States or Australia, which are relatively transparent jurisdictions. And so often market analysts, when they're looking at regulatory quality, they're looking at other proxies often, and they're seeing whether there are bank failures and scandals and other things that may reveal additional information about what precisely is going on within a particular country. When it comes to the question of whether international organization reviews can actually help provide outsiders with useful information, John Maynard Keynes made the argument some time ago, of course, that it was the job of the IMF to speak truth to power. The problem is that when it comes to financial sector stability reviews, the IMF was unable to obtain the agreement of the executive board, that is the country members, to link peer review of financial sector quality with IMF funding and conditionality. That is, the member countries really didn't want financial sector regulation and the implementation of agreed international regulatory standards to be linked in any way to their access to IMF funding or to policy conditionality. So that's a problem from the point of view of the IMF. For the Basel Committee and the Financial Stability Board, these are often what's referred to as soft law institutions. That is, they have no sanctioning capacity in themselves. They do undertake these new peer reviews, but largely they rely on market mechanisms. That is a kind of decentralized mechanism to encourage compliance with Basel and FSB standards. And it's also the case, finally, that market analysts are likely to invest more resources to understand a large economy, let's say like China, as opposed to a much smaller, less significant economy like Argentina or Indonesia. And so therefore reviews might be more likely to reveal information, to provide new information to relatively small emerging market economies in the G20. So from these considerations, we developed two hypotheses that we want to investigate. So the first one is that market actors are going to expect peer reviews by the Basel Committee and the FSB to be biased towards the positive. Because they're peer reviews, they're based on reciprocity, they're unlikely to be critical. Therefore, we expect when they are critical for this to be a relative surprise to market actors. So the basic expectation there is summarized in that table. So for the Basel Committee and the FSB that are producing peer-based reviews of financial sector quality and the implementation of financial standards, positive reviews are going to be taken with a large grain of salt because that's what they would expect. Whereas if you get a negative review from the Basel Committee or the FSB, that might be a surprise. And so we might expect a stronger market response because they're going to discount positive news. For the IMF, which is not undertaking peer reviews, this is the IMF staff. They're meant to speak truth to power. We would expect a more symmetrical market outcome. So if there is any market outcome in response to these published reports, we would expect a more balanced, symmetrical market outcome. If the report is positive, we would expect there potentially to be a positive market response and the opposite for a more critical review. Now, obviously, these are not, so the review, the sentiment in the review, that is the negative or positive bias, content, that's a continuous variable. So I'm simplifying here. It's not a binary variable. It's clearly a continuum. We'll say a bit more about that later. The second hypothesis is basically that the news content of published reports is likely to be greater for smaller jurisdictions in the G20. So we'd expect a greater market response for these smaller countries for whom the markets are investing fewer resources and have less knowledge about these smaller jurisdictions. So the basic method here is that we first do some quantitative text analysis, QTA. So we're looking at the content of the reports, the sentiment in the reports, whether they're highly negative, whether they're highly positive, or something in between. So we measure the text sentiment. Secondly, we do an event study. So as soon as the published report hits the market, we then measure the extent to which the market responds to these international organization reports, and we test our hypotheses. We use financial market data. Young might want to say a little bit more about that, but we can go into some detail there if you're interested. And then we proceed to stage 3, which is some regression analysis to test our 2 hypotheses. And we use the QTA and the event study, and we use some control variables. So the QTA, basically what we use are the country reports from these different websites. We scrape the websites, we convert the text to something that's clean, and then we apply a modified dictionary that other researchers have used. It's a financial stability dictionary that's associated with some authors from the US Federal Reserve. And we use that to measure the degree of positive or negative content in the reports. So we produce measures of sentiment by analyzing the text. Those are the different measures of sentiment that we use. Now, I just want to give you some indication quickly before I turn over to Young about how many reports we're looking at so far. Not massive numbers, because these are very time-consuming, resource-intensive processes, peer reviews and staff reviews. They take months. So at the moment, we've got 54 Basel Committee reports. So that's the Regulatory Consistency Assessment Program from the Basel Committee, the RCAP program. FSB peer reviews, 21 so far. These are all G20 countries, and IMF FSSAs, financial sector stability assessments, 53. That's a quick picture of the evolution over time. So you can see there that the IMF FSSAs dominated the space until 2010, when, as I said, after the GFC, basically we start to get these peer reviews coming in from the Basel Committee and the Financial Stability Board. And then the next diagram shows you, just hide that. So it shows the breakdown by country. So that varies. So Argentina has the fewest reports outstanding so far, only 3. The United States has the most. Just one last slide before I hand over to Young. So this is an indication of the sentiment analysis across different countries in these reports, looking at one of the sentiment ratios. So this is the critical ratio. The higher the critical ratio, the more the negative critical content there is in any given report. So you can see there's quite a lot of variation across countries. You might not be surprised to learn that all of these 3 global institutions are not especially critical of a country like China, or for that matter, the United States, although the IMF is a bit more critical of the United States than of China. But you can see there that the Basel Committee, so the first panel, the top panel there, that's the Basel Committee, has a strong positive bias. So we're seeing here relatively uncritical reports from the Basel Committee, a more balanced, symmetric set of reports from the Financial Stability Board, but on average biased towards the positive. So a critical ratio of 1 is neutral, and anything lower than 1 is more positive. And for the IMF, there's much more variation. So no particular bias towards the negative or to the positive in the case of the IMF. So I'm going to stop sharing now and turn over to Young to take you through the other results.
Okay, thank you, Andrew. I will start sharing my slides. Okay. Okay, so the second key building block in the research design is aimed at measuring the market impact of the publication of these IO reports. The methodology that we adopt is a standard event study approach, widely used in the finance literature. Now, compared to the first key component of this study, which is the QTA, the data that we use here is very different to the qualitative data and the documents that we use. For the event study, we use daily equity price data of the largest banks in the G20. We use a data set that consists of roughly 100 banks, which is the top 5 banks per countries, and daily prices from 2000 to the most recent equity prices available. So here we have a large volume of equity price data. So we've downloaded this from Yahoo Finance, and we've automated the computation of measuring cumulative abnormal returns, which is the key variable of interest here. We adopted the market model approach in trying to estimate the abnormal returns. So the basic premises here is aiming to understand whether the publication of IO reports lead to a abnormal return over and above or under the expected return for the banking sector. So the steps that we take to compute cumulative abnormal return is first to compute the returns for each individual banks across our time series. And then we estimate the expected return on the bank stocks, the individual bank stocks, as a function of the market within the estimation window, which we've defined as 90-day period. And then the abnormal return is computed by taking the difference between the actual return on banks' equity prices on the day of the report publication and the expected return, which was estimated using the market model. The cumulative abnormal return that we've adopted here is just a sum of the abnormal returns over the 3 days following the publication of these IO reviews. To take into account potential time differences, we've tried to lag the measurement of these market reactions by a day. We've also tested extending the measurement of the curve from 3 days to 5 days. And we've also used the basic approach where instead of estimating the expected return from we just use the actual market return of the benchmark index to compute the abnormal return. So the abnormal return here is basically computed for each individual banks, and then it's averaged across the 5 banks for the report publication dates. The final step, which we did to assess the significance of the abnormal return, was to see whether the market returns were significantly negative or significantly positive. In order to do this, we drew a random sample of cumulative abnormal returns from that country, and then we computed the quantile in which the cumulative abnormal return was observed and assessed whether they were in the bottom 5 or 10th quartile or the top 90 or 95th quantile of this random distribution. So later on, when we go to talk about the results, when we refer to significant market reactions, we are referring to cases where the abnormal return over the expected return is at the bottom or top end of this random distribution. So if we stop here, I think we could probably present these findings as a standard event study, but I guess the major contribution of this research design is that we're able to combine the sentiment indices that we have derived from the first component of this research design to then try to understand what is explaining these abnormal returns. So the third key component in our research design is just standard regression analysis. Again, similar to studies in the finance literature, we're adopting a simple linear regression model where we're using a measure of sentiment from the QTA as the key explanatory variable to explain to explain abnormal returns on report publication dates, which is the results that we obtain from the second part of this research design. And the key variables that we are controlling for include a number of economic variables, such as the level of economic development and the level of financial sector development, whether there's any difference across periods of economic stress, and so forth. We're also in the process of testing and controlling for a number of political variables here as well. Because this is a cross-sectional analysis, it's slightly tricky in the sense that we're looking at periods across time periods in time rather than across times. But here we've tried to capture some of the structural features, such as the IMF voting share of countries to see whether they're more aligned to the US or other countries, and to distinguish factors such as whether they're new or old members of the Basel Committee or the G20, which became much more prominent after the GFC. So just to sum up before we go to some of the key findings. So there's three key components in this research design, which consists of the first two, where we compute the sentiment analysis of the country reviews, and we compute the market reaction of the individual report publication dates for each and every report. And then the output of these two blocks of analysis are then combined in the third section, which is trying to understand how we can explain the abnormal returns, whether there's any correlation with the actual content of the reports that are produced by these reviewing organizations. So if we move on to some of the key results and findings, overall, we find that 1 in 5 reports published by these reviewing institutions produce significant market reactions. So these are abnormal returns of banking equity stocks over and above the expected returns from the market on the next day that these reports are published. We also observe significant variations across report types and across countries, and some of the key findings here are highlighted in the graph that you see on the right-hand side. So, oops. So as you can see here, we see quite a higher proportion of FSA review reports and Basel Committee reports that are followed by significantly negative market responses. And if we look at a rough estimate, around 8 of 10 significant responses for these reports are negative. And there's a slightly less proportion of negative market reactions for the FSB reports. I think this is interesting. It's also slightly puzzling. It could point to whether FSSA reports are still regarded as having more credibility than the peer review type of governance organization in reviewing our country's regulatory quality. But we can later see whether this is in any way correlated to the actual content of the report. So another interesting observation here is actually that there are also significant positive market reactions following publications. So, this notion of whether countries are rewarded or punished via via the publication of these reports is something that we later investigate. Another interesting feature, though, is again later on when we look at the drivers of these abnormal returns, is whether positive reports tend to have lower market impact or not. I'll slightly jump the gun here a little bit, but we find here that in explaining some of the negative outcomes versus the positive outcomes, we find that reports that have more negative content have greater explanatory power than the sentiment measured using just the positive index. Across countries, I think, again, very interestingly, we see negative market responses more for countries like Indonesia, Mexico, Argentina, Turkey, and South Africa. And interestingly, less so for countries like China and Brazil and India. Again, an anecdotal point that we found interesting was that there were positive market responses for US reports. So we later investigate whether there's any sentiment bias in favor of the US to see if the content of these reports tend to be more positive for the US or not. So the final kind of component of our research design is the, just one final point across time. So again, the key caveat here is that the FSB and Basel Committee started to produce reports from around 2010. So we don't have a huge amount of time series to make robust conclusions regarding the observations across time. But we do see a cluster of more negative market responses during around 2010 to 2012 when we had the European debt crisis. So European debt crisis for the European countries, but also if we take into account the fact that the report publication dates are usually lagged by 6 months to 12 months. So if the report is published in 2010, it's usually a review report of 2009. This does catch the end of the GFC period. So I think this period is interesting in the sense that there are small clusters of more negative market responses to IMF reports. So for the regression analysis, the results that we're presenting here are preliminary, and we are currently working on this part of the research. But we did want to share some interesting findings. So the key question that we are addressing here is whether market reactions correlated with the report content measured by the sentiment indices. And if we look at the preliminary results on the right-hand side, we have the different measures of sentiment, which is the critical ratio, and the negative ratio, positive ratio, and net negative. So these are just different measures of sentiment. And we find that just by regressing these on the cumulative abnormal returns, the estimated coefficients are in the expected direction. So we do see that on average, more critical reports tend to lead to more negative market reactions and vice versa. So more positive reports would tend to lead to more positive market reactions. In measuring the sentiment, I think the interesting finding was related to if we just measured the positive element of the reports, we find that this isn't statistically significant, which suggests that markets do tend to respond to negative or the overall sentiment of reports and could potentially discount more positive sentiment in the reports. So again, And while this is only preliminary and indicative, we do find some statistical significance in the estimated coefficients, and the direction of the coefficients are in the expected direction, which gives us a good base model to develop our regression analysis further. So just before I hand over back to Andrew, I think there were a number of comments that we wanted to put out to you. I mean, the first goes back to our initial expectations. So some of our expectations are supported by the findings from the study of market reactions and event studies, but others are more difficult to tangle out and tease out the findings specifically related to what it means. For example, when we look at abnormal returns, we would probably need to further distinguish whether these abnormal returns are response to information. So whether it tells us something about the efficiency of the markets, or whether it's related to genuine response of markets to country reviews, or whether it's reflecting, bias in terms of how the reviewers view the reports and respond. So some of the key questions are, why do some peer reviews have unexpectedly significant market responses? We found that for a number of limited cases, we found very sizable market reactions, and given the limitations of the event study method, those are the cases where we will need to check for any confounding events or variables. Another question is around how we measure sentiment. So if we look at the literature, a lot of the analytics component relates to how we clean the corpus. So data cleaning is a key area of the QTA, but also segmenting the text in terms of just looking at executive summaries or the whole reports, I think are other variations that we would need to measure. Some studies that look at media reports are able to gauge information by just looking at the first 3 sentences of media reports. So there are a lot of different ways that we can potentially test the measure of sentiment and enhance that element of the study. And then there is also the aspect on country transparency, market research, investment, and news content of these reviews. And here, elements such as the language, agency autonomy, or political opponents could all be factors that affect our results. In particular, from the findings, we find that the market response to the US report is a little bit puzzling, the positive report. And also, in order to provide more color to our findings, interviews of market actors could help why the market responds in ways that we find initially quite puzzling. So, Andrew?
Well, thank you very much, Young. All I want to say is thanks everyone for listening, and we'd be very keen to listen to your comments and questions.
Thank you, Andrew and Young. Is there any question in the audience? So otherwise, I have just a few questions myself. So I'll start and see if someone else. I just have questions on. So from the graph you showed about the critical ratio across countries, in slide what I can see here is 7. If you can. So in the peer review, there is very little, just the. Like there isn't much variation in terms of the scores. Relative to the IMF. So if like I think I was after an example of what a bad review could look like relative to a good one.
Okay.
do you have an example? Like what is if someone gets a 1.3, how bad that is relative to 0.7?
Right.
Yeah, I mean, I could say, give a quick answer to that. I mean, all this critical ratio does is it uses the dictionary, which we, as I said, modified from Correa and co-authors, and it counts the number of matches with that dictionary that are sorted into sets of positive and sets of negative adjectives. So basically, a report that has, let's say, 1.5 critical ratio will have 50% more negative counts than a report with a critical ratio of 1. So the difference between, yes, I mean, we could have showed some text, and we do some manual coding as well to check the quantitative coding. But yeah, there are some quite substantial differences. So a report that, let's say, produces quite a negative view. Let's see here, Brazil's FSB peer review report, for example, which is about at 1.3. You know, that's 30% higher than a neutral report in terms of the amount of critical adjectives used in that report. And if you look at a pretty low one like South Africa's FSB report, which is closer to 0.6 or 0.7, that's a pretty substantial difference in the broad tone. So if you compared the two reports side by side, and yeah, no doubt we would have to do that in a publication, and actually compare the sentences in which those critical adjectives are used. It is really quite a striking difference, and we've confirmed this, as I said, through manual hand coding.
Yeah.
And what consequences, like how does this critical, so apart from the return, you know, or that, you know, you have calculated, do you have any, you know, even example of, you know, like, is it correlated with really, I don't know, other things that you expected they would correlate with? Like, are these countries like, I don't know, Argentina has received repeatedly from the IMF, you know, help. So the fact that it's critical review probably here, even though there were only 3 or something you mentioned, but here it's one critical review they received. It was pretty harsh. Did it match with one of the years where Argentina, I don't know, was the 2001 one? It won't be probably because you have later years, but I don't know, like, does it match with something we would expect?
Yeah. Yeah, so it's certainly true. So you can see there on the left, Argentina receives a very critical IMF financial system stability assessment. I'm forgetting the exact year of that assessment. And then a whole series of very positive Basel Committee peer reviews of its financial regulation. It's certainly true that what we need to do is provide a bit more flavor of the evolution of that over time. I mean, if they were reviews done in exactly the same year, that would be more compelling of a substantive difference in the tendency, let's say, of the Basel Committee peer review process to produce relatively uncritical reviews. So I think you're right that if what you're suggesting is that we probably need to match the timing more closely of these peer reviews in order to, you know, reach a firmer conclusion that the Basel Committee is consistently biased towards the positive.
Yeah. Like it looks like it, but I don't know if it's.
Yeah.
I think it's really, you know, the method that we use is the dictionary approach, and in the field of NLP, this is probably the most basic and elementary, although most transparent approach. So given the simplicity of this method, it's actually quite striking how it does pick up sentiment from some of the reports. So you mentioned, you know, Argentina. So this is an FSSA report in 2016. So it does correspond to periods where Argentina was under a lot of debt distress. So the dictionary itself is a general dictionary. So it is tailored to measure financial stability, but we're looking at words like, positive words would be, things like efficiency, enhancement, profitable. Negative words would be things like delayed or, loss or words like that. But it interestingly picks up kind of sentiment in the way that, at least for Argentina, it is quite intuitive.
Yeah. I can see David has a question. David?
Well, yes, I just have one question and maybe a comment regarding the event study. But first, I find it really interesting that you find these effects because one would expect that the market kind of forms quite accurate expectations. Yeah. And as you said, these reports are like take a long time, and so you would expect that something gets out. You already find something. I was just wondering if you have maybe any idea to like better nail down the expectation of the market, so to really see like the deviation of what is expected, which is really tough to do. Of course, I guess the extreme critical or extremely positive ones might be surprising. So obviously in the middle is not, but maybe even the surprisingly good could be expected if one observes some reforms just in these years. So the market would expect that the IMF will be ecstatic about the changes in the country itself. So I was wondering if there's, I personally don't know, but I was wondering if you have any idea in mind already with this.
Yeah. It's a good question because, precisely, these reports hit the market, and the market will already have a consensual view, presumably embedded about, about whether, say, Australia has relatively good financial regulation, whether its institutions are robust, whether it's implementing Basel III. So most market analysts that look at Australia and Australian banks will already have a fairly clear view on these things, you would think. So I agree. I was surprised by the results that we're consistently finding that in a substantial number of cases, we can detect a significant market response here. The difficulty, of course, is trying to measure on some kind of ex-ante basis what the general sentiment, let's say, about Australian regulatory quality in the financial sector is. We were talking earlier today about the possibility of using credit rating agency assessment of financial sectors, for example, before these might in some way both shape the market consensus as well as reflect some kind of consensus, or at least the kind of well-informed side of the market. There's a general sense for example, Australia tends to have a fairly positive reputation for institutional quality and implementation of things like Basel and FSB standards. So anything critical of Australia, you would expect. So there are various indices of institutional quality. The World Bank and others provide general reviews of quality that are not specific to the financial sector, but which may also again reflect some kind of embedded ex-ante market understanding about what these reports will, when they're published, say. So yes, we need to look more closely at this. Obviously, the further you move away from the event window itself, it starts to get very difficult to say, reach a firm view about what the market expectation will be. So these reports land in an expectational context, and the question is whether the markets are surprised.
Yes, the first thing that came to mind, I guess, also these rating agencies that they might have like to get this text and look at the sentiment, or maybe the Wall Street Journal to do like a preliminary search of articles in the banking and I don't know, like some keywords to gather some kind of text corpus, and then in between those reports, if like the sentiment might change until the report is is published. So maybe you have like a, a base where you know, well, maybe it was pretty positive according to those news articles in the Wall Street Journal.
Yeah.
But then you get this report and it's super critical. I guess, I mean, it would, if anything, it should only increase the significance of your results, right? That's what your results are probably the lower bound, because it assumes that the market is really hit by great surprise on this day.
Yeah.
The last thing, maybe just as a comment, have you tried for the event studies? Have you tried any other test statistics except for doing the random draw or like of a sample? I was just, for example, I thought about event-induced volatility. So if you have this really critical support, like report that might be a bit of a shockwave on the day through the banking sector. So any random sample drawn within the estimation window might not be able to capture this increased volatility in the market in general. So this, but yeah, I mean, there's so much in this literature, so many test statistics. I was just wondering if it might be worthwhile to like do a couple more just to know if all point in the same direction.
Yeah, good suggestions. Thanks. Do you want to say anything about that, Young?
Well, I just wanted to add that it is indeed a pleasant surprise to find this level of abnormal return. I think, if anything, a lot of hedge funds would be interested in what are the drivers of these abnormal returns, because they are quite sizable for some of the reports. We're looking at, for example, negative 6% return across banks on average, below the market return on that day, and that's quite a big big amount. And the interesting point here is, again, the traditional literature in finance draws from the efficient hypothesis, the efficient market hypothesis about whether markets are sufficiently, pricing in and incorporating all available information. Now, again, it's slightly, this is the bit where we find the results very interesting. So if certain markets, like if Indonesia is, Indonesia is a very inefficient market, then we would probably find consistently negative market reactions or consistently positive reactions, because we're looking at market response to reports in a particular market, and that particular market is defined by a certain degree of market efficiency. But what we find is that these abnormal returns are quite varied across countries, which suggests that it's not just the characteristics of the market in terms of market efficiencies that are driving these abnormal returns. So that gives us a particularly interesting finding to then try to seek to explain these abnormal returns in terms of the content of these IO reviews, rather than just stopping here and making comments about the efficiency of the market.
Paul has a question as well, and then it's Sasha.
Thank you. So the first question or comment I have is, so I'm wondering, I mean, one would assume that, for example, big institutional investors would have people who have the time and the knowledge to read those reports, but maybe a lot of other market participants would just use the summary that's printed in the Wall Street Journal or Financial Times. So I was wondering whether you could, I mean, it's, sending me off to a fishing trip, but whether you could use the text corpus from some of the key financial news reports that report about the finding of these reports and look at the sentiment. And I mean, of course, that should be correlated, but still it's an interpretation from the reporter and their sentiment might differ. And so the interesting bit would then be to just see, and I don't know about the literature, whether, market decision makers take actually the key report, so that's the quote unquote true signal, or the summarized interpretation from the news media, and to get a bit of a handle on, what news source do financial decision makers actually use. And there, I mean, relative to a lot of other event studies in this area that either just uses the event per se or news reports. Here you have both. So you have the truth and the media report. That's the first one. And the other question, also related to David's comment, can you look at whether there's an effect on other markets? So one typical thing people do is to look at derivative markets. So, you know, put call options on these banking stocks, or given the importance of the banking sector, whether it has an impact on government bonds of the respective countries. Because if, you know, if the IMF tells everyone that your banking sector is pretty in bad shape, this might have, you know, further, you know, bigger effects on how other financial products related to a country are affected.
Yeah.
Yeah, I think, I mean, all I'll say is I think they're really interesting suggestions. I agree we should do both of those things. So thanks, Paul and David. Yeah. Just one quick comment before listening to Sasha. Another aspect is potentially that the timing of these reports' publication may be endogenous as well, in that governments may collude with, let's say, the Basel Committee not to publish a report during a particularly volatile period. There's certainly been cases in the past where countries have blocked IMF reports because of a fear of market reaction. So that's something we also need to investigate. And so if you get a string, for example, of newspaper reporting from the Wall Street Journal, which is highly critical, let's say, of a country's financial sector stability, the probability of that being followed the next day by, the latest report saying that things are even worse is probably quite low. So we need to think hard about these sorts of things.
Yeah, I think it's certainly an interesting point to investigate further in terms of how the decision makers, the market participants, consume these reports. We might not necessarily find consistent messages between the original sources of information, which are the IOs, the reviewers, and the media. The media may again take a different view, or could interpret the information in ways that are not entirely the same as the original publishing organization. So that would, I think, provide an added dimension to the various sources of information that are used. Yeah.
Sasha?
Yeah, my question is more or less answered about endogeneity of the report, because I was thinking about this paper, which I'm putting in the chat, When to Drop a Bombshell, which has this idea of strategic launching of a report to damage someone. And I'm wondering whether you could get from the documents themselves, often it's super bureaucratic, right? That it's kind of a received on, published on, maybe somewhere in the document, that you can see the time gap between when it was drafted, maybe even from the document properties, when was the PDF created? Could be super interesting to see, to calculate that gap. That would speak a lot to international relations and how strategically some countries can arm twist their way. That would be super sexy, I think. Yeah.
Yeah, that's a really interesting suggestion. I agree. We do know, for example, that China systematically blocked all IMF reviews from about 2007 to 2010. That was largely to do with currency manipulation disputes between the US, China, and the IMF. But other countries have been known to delay publication of review reports. What we don't have a good handle on is how long they can delay. In some cases, they block publication altogether, but in other cases, reports are delayed and then released at a later date. But I think that's a great idea if we could get information about that.
We are perfectly on time, even for economists.
Well, I would have a quick question or a suggestion.
Klaus, go ahead, go ahead.
I tried to share a file, I can't do it. Can you stop sharing so I quickly share my screen?
Yeah, just give me 1 second.
I think I've stopped it, so you should be able now.
Oh, host has disabled screen sharing.
I've just made you a host.
Ah, okay.
You should be able to.
Just a quick suggestion regarding news feeds for analysts. Yeah. So this is just a standard screenshot of this Bloomberg terminal. Yeah.
Mm.
And what they see here is just the headlines popping up. Yeah. So that just to follow up on Paul's idea that to judge who is watching. So if you just get the headlines, because something like roughly like this here, that's what they see. Yeah.
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 So
I think Bloomberg even have their own sentiment index. I'm not sure if it's, I can't remember if it's Bloomberg or Acorn, Thomson Reuters, but I think in the field of media reports, I think it is become pretty informative indicator. You know, as we can see on your screen right now, I mean, there's lots of reports, and these report lists just flash through your eyes every second.
yeah.
And for human, it's very difficult to pick up these information.
So what you're saying is we should also measure the sentiment embedded just in the titles that appear.
Yeah.
Yeah.
Because I mean, not right now. Sometimes those things change color. Like sometimes it's red and says, "Oh, something," but not now. But
yeah. Yeah. Thanks. That's a great suggestion too.
yeah, so just an idea. Okay.
Mm.
You're
Very helpful comments.
Also,
Thank you.
another one on timing. Who generates the master plan when a report is due and what comes first? So one thing is, once there is a schedule, pushing back and postponing, but who does the plan in the first place? And can countries play games like peer review? It's not just document based, I assume, but people travel to country A, B, C and go and visit, right?
Yes.
So can they play games with visa and with the prime minister has no time to meet you, we have to meet 2 weeks later, this business. And recently we had someone talk about private jets and government jets and stuff, and I don't know whether you can somehow even find out when the commission traveled.
Yes, so there is these organizations, I think in all 3 cases, put on their website what the schedule of future reviews is going to be. So the IMF will say, we're going to do these reviews of these countries over the next 2 years. In the IMF, the top 25 systemically important countries from a global financial stability perspective all are meant to be reviewed every year because of their systemic importance. But they do publish a schedule, and so do the Basel Committee and the Financial Stability Board. So we might be able to use that, even if you know, they don't leave traces in the Adobe PDF or whatever of when the document was published and when the review was actually done in practice by the review team. It's also true both for the IMF but also for the 2 peer review organizations that the country gets a chance potentially to play games with the text itself. That is, they can object to particular sentences or information that's released in the text. There was a strong presumption after the GFC that they should do this much less than they had in the past with the IMF's, particularly the IMF's Article 4 reviews, where countries can object and excise, edit material out that they don't like or that could be embarrassing. So there's meant to be a presumption that everything would be published, but whether in fact that actually takes place is, I think, doubtful.
And a technical question, are the reports one shot, or is there a revise and resubmit? So does the country that's being inspected have a chance to respond?
Yeah, so there's a country response usually embedded in these reports. So that'll typically be an appendix where the country says, we don't agree. Thank you very much for the, report. We, the team did a good job and so on. We think they got A, B, and C right, and they got D, E, and F wrong. And they don't understand this about Indonesia. So there is usually a response embedded.
Yeah, because there may be, I find it so cool. There is so much to be done, I think. Also, in terms of strategic, you may partner with your referee because you want to push domestic reforms, but you want someone else to tell you. Yeah. You may invite certain comments because then you can tell the opposition that, look, they told us to, a bit like inviting consultants, no? It's if you are weak internally, you call in McKinsey, right?
That's right. And so, for example, in the 1990s, there were some incredibly critical reviews of Japan by the International Monetary Fund, when everyone was complaining about how bad Japan was governed, how the banking system was insolvent, and the government and the financial regulators were in cahoots with the bankers. But there were some reformers in the finance ministry in Japan who were openly encouraging the IMF to make these critical comments as part of the internal domestic reform struggle in Japan. So absolutely, there's a lot of domestic politics involved in this as well as international politics.
And I think,
yeah, go ahead.
I was just wanted to add the final comment that we did find some anecdotal evidence where people close to the process did indicate that this sort of process might be in play. So this is one of the key points that I think would be very interesting to follow up on a case-by-case basis.
Yeah.
Sorry,
Andrew and Young, I'm just mindful of the time, so I think we can conclude here. If people want to stay around, I'll stay a few minutes more, but I feel like it's we're already over time. Yeah, so it's officially closed. If you need to go, you can go. But if you want to stay and have other questions, stick around a few other minutes.
Yeah, well,
thanks both.
Thank you.
Well, thank you. Really helpful comments. So